Hello guys, apologies for the slight delay of my webinar tonight. Unfortunately, I've just had some technical issues with the start of Zoom tonight. Hello guys, and I've just noticed I've got to re-echo there as well. So thank you and good evening and welcome to tonight's episode of Optimise Accountants Property Q&A, where you, the listeners, get to listen to me ramble on for about 40-45 minutes, depending on how many questions that you set my way. I will be breaking in this section into three parts, which the first part is being in the news. So I'll be describing to you what I've been watching in the news and listening in the news and reading in the news. And I'm going to be bringing that to you today. And some of my own insights in terms of what I've been looking at in the news as well today for you. The second section is all around property clients that we have on our books, what they've been asking in the past 24 hours, 5 working days, and I will be giving those kind of insights of what we've been responding and how we've been helping our clients as well. And the third and final section will be up to you. So I will be staying on this channel for as long as you'll have me, based on any questions that you have. So if you've got any property investment questions, then make sure that you start typing those into the box below or to the side of the navigation bar. Or indeed, if you've got any buy-to-let property tax questions, then make sure that you put that on there as well. If you do like this video in terms of what we're doing tonight, make sure that you give this a great thumbs up. If you haven't subscribed to the channel yet, make sure that you press subscribe down the bottom, press the notification button so that you don't miss any videos that we're launching. And just for your information, we are launching a new video on Thursday all about extracting money out of a limited company. So stay tuned for that. But let's, what I've done for you tonight, I thought it was a bit boring last time, but I have just a blank wall behind me. So I thought I'd do something slightly differently with you guys. And I'm hoping this is going to work. What I'm going to do for you is just share my screen and I'm going to talk to you about what's in the news and how it's been going on. So what I'm going to try and do is go to Google Chrome and then hopefully you'll start to see my video coming up. So let me just see if this works. So this is what I would call in the news. Now, I'm just going to check actually, because this is the first time that I've ever done this. So forgive me when I'm just going to hear me typing away. Just to make sure that technology does not let me down, I'm going to just open this up on Safari, just to make sure that I'm not screwing up as I'm trying to record this for you. So I'm going to be purposely putting something in the news for you. And I'm hoping that I'm showing my screen, but I'm just going to do a quick test just to make sure that it's going live. So I'm just going to do that now. Perfect. You can see my tabs. So that's good. So feel free to let me know if something's not working. I probably should use this on my iPad going forward, but anyway. So what I thought we'd do is on our website, you'll notice that we've now got a new section called Property News. This is a daily newspaper and it will be refreshed on a daily basis. I appreciate that you're watching me today on my smaller me in a minute. So I'm going to put me, can I put it up here? There we go. Oh, that's a bit too big. Ooh, scary. I'll move myself over there. So I'm now on your top right-hand corner of the website, and this is our news, which will be refreshing on a daily basis. So it's something that we've been working on for a period of time, and it helps us deliver better content for you property investors, landlords in the UK that's worried about tax changes, worried about legislation changes, and so this helps you along. And what I've done on this particular section, you'll notice you can subscribe to this, by the way, on the, not the YouTube channel, but you can subscribe to the newspaper as well. So pressing on this just allows you to put in your details and it allows you to put in your email address. There you go. So there's nothing to it more than that, to be fair. So feel free to subscribe to the daily chat, to the newspaper if you're kind of interested in that. And I've also got the Monday night webinar link as well, so for you to take that on board. So let's talk about what is in the news. I think that's after all, that's what we're here for. So the first bit I wanted to talk about is this particular section. I'm just going to zoom this up slightly just so they can see it. There we are. So here we are. So this is the first one, which says London remains a tax haven for world's dirty cash. And Simon Jenkins has written this particular piece. And I'm just going to go into each piece so you can see what I'm doing in there. There's Simon Jenkins right there. And this is The Guardian. So The Guardian, good reputable paper. And I don't know if you can see the highlight. I'm just going to zoom that up so you can see that. But basically what's being cited here is that it's anti-money laundering. But property still seems to be the way to get money into what he's saying is bringing dirty money from foreign countries. Now, if you try and move 5 million from one bank account to another, what he's saying here is that you will be investigated. They'll have to have proof funds, where it's come from, how did you get that money. But if you put it as a deposit in a property, no one seems to bat an eyelid. I'm not so sure that's true because I think most solicitors have to go through some sort of anti-money laundering. But it was just an interesting piece of where kind of he's saying that money does flow through properties and almost avoids the amount of red tape or legislation catch-all for laundering money. Interesting article. Feel free to read that in your own time in terms of the Guardian. I thought it was interesting just from a perspective of, it's, again, property that seems to be getting the bad press around here in terms of not just tax and landlords being crooks, but now it's we're laundering money from other countries into property. And I have to say that that's to a degree is a little bit true. Not that we're laundering money, don't get me wrong, I'm not saying that's what you're doing. But whenever I speak to solicitors in this country and we're using joint venture money, then the money might already be sitting in the bank account and they may not scrutinize that as much as if you are physically transferring the money from you as an individual. The fact that the money is already sitting in a limited company, there's a chance that that money may be less scrutinized directly. So that's an interesting piece that I picked up, again, from our property news from our website, as you can see there. The second piece, which was interesting, I'm just going to scroll down to this, is this beneficiary income company trust. Now, let me just talk to you about what a beneficiary income company trust is. In Section 24, people are investing in limited companies or LLPs. Now, that's to avoid the Section 24 mortgage interest relief cap. So a company, a partnership's been set up, let's call it husband and wife as individuals, and then you've got this limited liability of the partnership, but the third partner is now a limited company. And what's happening here is that the limited company is the one that's siphoning off all the profits, leaving the two individuals with not much money left in the coffers, which basically means that they're trying to mitigate Section 24 using this beneficiary income company trust. For me, it's an artificial structure. It's going against GAR in many ways. GAR stands for General Anti-Abuse Rules. And GAR was set up to stop people using limited companies' tax structures to get a tax saving. And if you think about a beneficiary income company trust, so you've got the two individuals as I just described there, and then you've got this limited company, it basically means that they are doing away from the tax disadvantages as individuals and getting the advantages of corporation tax in the limited company structure. Well, as I've just said, GAR will go against it. So I'm personally not a fan of these BICs, as you might have heard them called itself. But what I thought was interesting was this came from Mortgage for Business, so just a piece that they wrote. Jenny Brown was the author of it. And I just want to kind of go down to the impact of lending if you are choosing to use a beneficiary income company trust, which is that artificial limited company, if you like. And part of that was said that they interviewed or questioned 41 lenders, and just 4 of those 41 lenders said that they may consider lending to this BIC structure. And I can understand that, because what we're saying here is that the mortgage would be with the individuals, so they've got the responsibility. But the way that the scenario is built here is that all the income goes to the limited company, or the BIT, if you like. And therefore that brings a whole new issue, because you've got this whole point of the company's making all the profit, but the individuals are responsible for mortgage. So it's a greater risk for them. And the mortgage lenders saying, well, we're not really comfortable about that, because it's really, you've got responsibilities for the mortgage. If you're not getting the income, how can you be really responsible for that, this mortgage interest payments and capital repayments? And therefore, this extra layer of risk, not just from HMRC's GAR, but because of the way that banks will look at them. And I've heard many barristers that say, look, we can set up this LLP structure with this company, but you don't need to tell the mortgage lenders, which I think from an ethical point of view, I think should be transparent in what you're doing in business. That's not transparent by not telling your lenders that you're using this big transformation, this change. And therefore, if they did hear about it, they probably wouldn't lend the money to you anyway. So that's the second reason why I wouldn't use BICs. So over to you guys. Please type into the comments box below, have you used BICs? Have you been told that the LLPs are the most tax advantage structures that you can use? And listening to what I've just said now about GAR and the way the banks looking this BIC structure, are you any more confident about using this BIC structure, or are you less confident about using this BIC structure? So please type in yes, more confident about using a BIC structure, given what I've said about GAR and the lenders, or are you less? And tell me why as we go through tonight. It'd be really interesting to see your insights. There's a lot of it going about into the forums. I'm not going to go into which one it is, but I do think that this whole BIC scheme setup, for me, it's another film tax evasion, which will be unraveled pretty quickly. And therefore, it's you, the taxpayer, that be liable, not the lawyers that are selling this scheme onto you. So do bear this in mind as and when you're going through your informed decision-making process, whether to use a company structure using BICs to save tax on Section 24. Something for you to bear in mind. Okay, so that's the second article that I thought was interesting. Another company, Wired, is also talking about London's property boom is a money laundering horror. So I'm not going to go into too much about that. Interesting enough, on our paper, we will be introducing videos as well for something for you to be maybe watch in your spare time. And there's Samuel Leeds talking about why he does his videos for free and why he teaches people for free. So have a look at his video. Very interesting character, very full of life. So if you need entertaining and a bit more kind of energy put into you from his type of videos, then do feel free to go onto our website and you can watch directly his videos. The next piece I want to bring to your attention was this one, which is UK taxpayers to be given warning of 30-day CGT payment deadline for property disposals. Bit of a mouthful, I have to say. But one thing I would say about that is that I'm just going to go to the article, actually. That's probably better. There we go. So this is an article, again, from an organisation called STEP. This is the industry news. So UK taxpayers begin special warning of 30-day CGT payment deadline for property disposals. Well, it's nothing new, really. This has come out really in last year's legislation. And basically what's going to happen is that after April 2020, when you make a disposal of a property, the laws will be changing in as much as that you have to pay your capital gains tax liability 30 days after the disposal. And let's just kind of, I will talk about CGT later on, because it was an interesting question that came out from a client of ours. And really, we answered that quite well. in terms of how they could save on CGT. But capital gains tax, for all intents and purposes, is the sales price that you get for the property, less the sales selling fees, so the estate agent. You've also got less the purchase price of the property, which includes the solicitor's fees again of procuring that property, plus the SDLT charges that you may have. And then you've got any capital expenditure that you may have incurred on the refurbishment. That gives you then your profit or your gain, and then that's taxed after you take away a further capital gains tax allowance, annual tax allowance, which is £12,000. That's per person or per owner of the property. And then you're taxed at either 18% or 28%. There are further reliefs, and I'll talk about those further reliefs later on. But what they're basically saying is that before you had, let's say, imagine that you sold a property in July 2019, well, you wouldn't have to put that onto your tax return until April 2020. And then you've got another 9 months in effect to pay your capital gains tax liability for the 31st of January. So you've got a long, long time to pay it. Well, HMRC clearly want their money in a lot sooner than ever before. So this is why they've introduced this new 30-day ruling. Now, one thing you do need to bear in mind here is that, and I'm sure that the person who wrote the article has mentioned this, is that it could well be the solicitor that is the person that not only calculates the SDLT for the purchaser, but they will also have to calculate the capital gains tax of the disposal. Really? I mean, they're going to calculate, bear in mind what I've just said here, they're going to take your sales price proceeds, less the sales fees, less the purchase cost, plus all the stamp duty land tax, plus all the capital costs, and they're expecting you to deliver all that information within 30 days so that they can do the calculation. Plus, you don't even know what tax liability you're going to have, because are you a basic rate taxpayer or you're going to be a high rate taxpayer? And who knows? You could be broaching both areas. So now what the lender doing, because they're solicitors, is that they will charge you 28% capital gains tax, and it's likely that you will have to then reclaim the overpaid tax on CGT from HMRC with your tax return. So basically what they've done is they've engineered it, and I say they, HMRC have engineered it so that they get their tax up front, and then you have to claim back any overpaid CGT. So if you are thinking about selling any of your property portfolio, make sure you do it before April 2020, which doesn't give you that much time to do it, to be fair. So really kind of do focus your efforts in getting that done sooner rather than later. It can be a disaster if we're not careful. So please, please, please make sure that you plan ahead. When you're looking at any disposals, if your Section 24 is affecting you and you think, well, actually, I've got one or two bad properties, maybe now is the time to dispose of them before April 2020 comes into effect. And I've got some more bad news about April 2020 and capital gains tax as well. First of all, private residency relief. So let's imagine that you had a property. I'm just going to go back up so people can know what it's all about. But let's imagine that you had a property, you lived in the property, and then you moved out before you had this extra time. So let's imagine that you left the 1st of January 2019. You would, technically speaking, have 18 months where you would vacate the property. So June 2020, which is the 18 months. Yes, that's right. And that period would be no tax because it would come under private residency relief. Well, now, well, not now, but since from April 2020, that has been reduced to 9 months. So if you sell your property 1st of January 2019, let's call it 2021, because that's the new tax year, you'd have until the end of September. That period would be exempt from capital gains tax under PRR. But then beyond that, it wouldn't be. So you'd lose 9 months worth of PRR, and therefore you'd be paying more tax. Not only that, But HMRC have also said that lettings relief is also going to be recalculated. So what's going to happen, lettings relief is the lower of the PRR value, £40,000, or the gain itself. So you don't get huge amounts of relief, but you do get some relief if you've lived in a property and then you subsequently let it out. Well, in April 2020, everything changes. So you will only get lettings relief if and only if you then lived in the property at the same time as the tenant. So if you vacated that property and then the tenant moved in, you will no longer be allowed the lettings relief to reduce your capital gain, and you will be paying more tax as a result. So guys, is that new to you? Is this the first time that you've heard about the 30-day ruling, the reduction of the PRR and lettings relief? If so, what's your thoughts? Please type that into the comments box. If you've got any questions, clarification questions, feel free to type those in now, and I will be sure to answer those in this session, or indeed if you're watching later on, then I'll be coming back to you with those answers. So make sure that you do that as we go through. So hopefully this has been useful for you so far. So like I say, if you're giving me a thumbs up, please do on this video. So it really does help me with the SEO and pushing my rankings up on YouTube. So I've got nearly 1,000 subscribers, by the way, but not quite there. So if you can help me out with that, that'd be fantastic. Please do share our videos, and let's get more people to like this video, like our channel. So when we're doing this Q&A, it's a bit more entertaining in terms of the Q&A that you may have, or the questions that you might have, and my answers. Hopefully that will give you answers. Hopefully you can see, and I'm back on the big bottles of water, trying to drink my 2 litres a day. Hard going, I have to say. So let's talk about some other wines. So this is another, again, on our website, Optimise Property News, which is a daily newspaper for you guys. So feel free to go on our website, www.optimiseaccountants.co.uk news, and then we'll be sending that to you. The other piece of, and there's your subscription. So if you do want to get this into your mailbox every day, then all you need to do is type in your email address, put in the word that comes up when it's refreshed. It's not happening on my system, and then press yes, I'm happy to subscribe. And then we will just send you just this newspaper, nothing else. So this is another piece of information I thought was really good in the news that came out. And this is from more investors should claim SDLT rebates on uninhabitable additional dwellings. I'll say that again, uninhabitable. I've just challenged myself to make sure I didn't slip up there. And that's on additional dwellings. So what is this all about? Well, if you're buying a residential property, especially when it's an investment, or you've got one property in your own name already, or you're buying inside a limited company, you will pay the 3% additional surcharge. So this is a 3% SDLT surcharge that you'll be paying if you already have a property in your own name, which you're not selling, or you've got a limited company and you're buying it in there. What was this article about? Well, this was a real interesting one. And this is something that went into court. So this is now beginning to be case law, and could be really interesting for people that buy properties that are not habitable at the time of purchase. And I'm going to give you an example here. If you are buying from an estate and you're buying from them, then you don't normally pay 3% SDLT surcharge, which is an extra bonus bit of content here, if you're a property developer then looking to sell it on. Okay, so let me state that one again. If you are buying from a deceased estate, so the executor is selling a property, and you are a property developer looking to purchase the property inside your development limited company and then sell it on again, then you don't have to pay the 3% SDLT surcharge, nor do you have to pay the normal SDLT residential rates either. But this is slightly different. This is whereby we've said that you may end up looking at buying the property, but it's not habitable at the time. And the 3% SDLT surcharge basically saying, well, if it's habitable, then you should pay the 3% SDLT surcharge. Well, what was really came out of this, which was really, really interesting, and I'm just going to hover this for you. It says, in the case of the Booley property, the asbestos-filled dwelling lacking central heating made habitation dangerous. I've slipped over on the most basic word there. How on earth I did that, I don't know. I've been practicing this for a while. So this case will mean that a significant number of investors will benefit from new boundaries regarding the surcharge, which will be a bittersweet to HMRC, as around half, 1.6 billion, nearly 1.7 billion, of all SDLT revenue was squeezed from additional dwellings from 2018. This is going to be huge. So if you are now buying boarded up properties and you can say, well, no one can inhabit this property, then there is a challenge that the 3% SDLT surcharge could be avoided. More to the point, if the property isn't habitable at the stage, does this not indeed bring to question altogether the residential rates of SDLT? Because SDLT residential rates is all about a property. If this is talking about habitation, being able to live in a home, then surely not only should the 3% SDLT surcharge be questioned and removed, but also the SDLT residential rates, should that not be converted to non-residential rates because we can't live in it? I'm not so sure. I'm not going to go into that in this one. But it was just an interesting one, and it's something you can read more detail on. That's from today's Conveyancer. So again, go through our website, get to it there. But a real interesting article came out of that one. So have a good read of that one. It could be a way of reducing SDLT rates, which is all good news. So here's a piece that I'm not going to go into too much detail here. This is Money is saying that HMRC announces it has missed out on collecting 35 billion in tax in 2018. Whoops. If you missed out on 35 billion, wouldn't you be fired for that? Just saying, hashtag. Got that the wrong way around, didn't I? It's hashtag just saying. So yes, if you had made a faux pas of 35 billion, I think you might be kind of in the office's meeting room and maybe getting grilled a little bit. But anyway, so we'll move on from that. So this is another piece which is Simply Business, sorry. Talk about major changes in taxation for owners of buy-to-let properties. And let's be fair, there's nothing new in this article, but it does talk about Section 24. And in this element, it talks about how the mortgage interest relief is being phased in from the 16-17 tax year all the way through 2021. So do have a read of this. It's a nice overview, to be fair, of the tax, and it's got some examples in there as well. So we've done a piece very similar to this, but sometimes it's good to read other people's articles, just get their slant on things. So feel free to have a look at their website. Very, very interesting in terms of what they talk about. And that was pretty much it. Was there anything else? Oh, I'm not going to talk about that one. And that's the same thing that I've just talked about. Was there anything else? No. So that is in the news. So has anything come out of this first section that was a bit of a surprise? So we talked about CGT, we talked about Section 24 very slightly, SDLT, two of the areas that you can pay tax on, and we've just alluded of how those taxes may be minimized. I'm going to talk about CGT even further, but has this been useful? If so, don't forget the like. But equally, just describe to me in the comments box what you found useful so far. But if you have any questions of what I've said tonight, then feel free to type that in the comments box, because I can then press reply and respond to those. Or if you are live and I'm still here, then I will respond live as well. So let's just head over to see if there's been going on in here. So Yumang, it's great to speak to you again. It's been a whole 3 days since we spoke. So welcome aboard, Optimise crew and family. It's nice to have you on board. The question is there a way to counter these additional taxes by doing something now? Yes. And I guess what I would always say, because you're client of ours, is if you think about buying a property and it's a specific property, not just a generic one, because we need to know the specifics. But if you've got specifics in terms of buying a property, refurbishing a property, selling a property, all of those taxes we can minimize for you. So it's better to probably book a tax call, you may. I know that you're on board with this now, so that's always a good thing, just to book a tax call, speaking about those particular situations that you're facing and how we can minimize it. The answer is yes, I'm sure we can help you reduce it for you as a client, but more importantly, let's get some real juice in that into the discussion. Emily's asked a question, so if you moved out of a property and let it out, then after 3 years you decide to move back in, how does that work? That's a great question. So there are ways of minimizing CGT, Emily, and I'm going to talk to you about that in just a second, because that was a question that came up last week, and the solutions were going to be talking about that very thing. So do bear with me a second as I talk about that through with you. But for anyone listening in now, you can go on our website, www.optimiseaccountants.co.uk, and what you can do is go on to our consultation options, discuss our services. So if you want to know about what we do, make sure you go onto that. But also, if you want some specific tax advice, then make sure that you go onto www.optimiseaccountants.co.uk and use the code YouTube25. That'll give you 25% discount. So if you are kind of got a specific tax question you need some support on, use the code YouTube25. That will give you 25% discount off the £300 tag. And then you can ask your questions. And what you'll be able to do is upload documents, put in the form your questions, and then in the morning, the lead accountants will be able to look at those and they get you the solutions that you deserve. The call is recorded and we will always be sending that information to you after we've had the conversation, so you can re-watch or re-listen to that conversation at your own time. We'll also send you the notes as well to those calls. And you might, just in case you don't know, I know you've got a call, but actually, funny enough, I think with Lynette, I believe. So you will be getting those kind of recorded sessions with us, and you'll be getting the notes after the call as well. Okay, so let's talk about our clients now. What I'm going to try and do here is find a way now of going into my directory now. For whatever reason, I've lost it. So let me just go to broadcast there. What I'm going to do is do a new share. And what I'm hoping to do is go to my documents, which hopefully you can see. Okay, here we are. So this is the client FAQ, which came up this last week. So I'm doing a review now of that. And again, if you do have any questions about the things I'm talking to you about these subjects, then feel free to type those in. I will be getting back to you tonight. And if not, if this session's finished and you're rewatching this, then I will be recording that. I will be going back to your questions within 36 hours typically, and then placing my answers just below in the comments box. But hopefully this is good. I talked about what capital gains tax is. So this particular client was saying exactly the Emily question earlier was, well, what happens if I move out of a property? Can I say, and move back into the property, can I save tax? Well, I'm not going to go into the details of CGT because I've already said it's the difference between the sales price, the purchase price. Blah. You've kind of heard me say that, so I'm not going to go through too much of that. And I've also talked about the capital gains tax allowance. Now, the interesting thing about capital gains tax allowances is that if you're husband and wife, you could transfer assets between husband and wife, and there'd be nothing. There's no tax consequences at all. Maybe SDLT, well, that's another subject. But from a capital gains tax, there's transferring assets. There's no issues there. But let's imagine that you've got one person, let's call it the wife, who has a property, and she's thinking about selling the property, she can get £12,000 worth of annual capital gains tax allowance. Okay, that's okay. But now she's got this husband, this husband, him over there, who doesn't do the cleaning, naughty husband. But she has this property, and he is over here, not doing anything, idle, sitting on the settee probably, watching TV. But he's got this annual CGT allowance as well. So you can do a deed of trust, which basically means she can transfer 50% over to him, and then they can sell the property, and then they're going to benefit from 2 lots of annual CGT allowance. Not only that, but they can do a different split. So it doesn't need to be 50%, 50%. She could be a high rate taxpayer. He could be a basic rate taxpayer because he doesn't do anything. But there could be a situation whereby the split may well be 10% to her, 90% to him, in order to reduce the capital gains tax liability. And we have calculation spreadsheets to help you with that as well. So that's something that you do need to bear in mind. Let me just get rid of that. Yeah. So we talked about private residency relief, reducing from 18 months to 9 months. We talked about that. I'm not going to talk about that again. Lettings relief, basic rate tax payment of 18% to 28%, and mitigate CGT using EIS. Now let's just talk about this. If you've got a gain of £100,000 and then you invest that gain of £100,000, which is now taxable, into an EIS, EIS stands for Enterprise Investment Schemes. SEIS could stand for Seed or Small Enterprise Investment Schemes. And then you've got VCTs, Venture Capitalist Trusts. By the way, I'm not a financial advisor. I'm not giving you financial advice on these types of investments. What I am saying is that there could be a good tax relief, because if you invest all of that gain from selling a property and then you put it into one of these investment vehicles, you would not have a capital gains tax liability at all. You're kind of deferring it. Not only are you deferring, but if you do things correctly, you would never have to pay that capital gains tax liability at all. So something for you to bear in mind. Now, so Emily talked about, well, what if you left a property and then came back in? Well, that's an interesting question, because if you did do that, your private residency relief would kind of restart. But not only would it restart, there are exemptions. So let's imagine that you left a property 1st of January. We know we're going to get PR for 9 months in the new world. But let's imagine that you left because of a job. And it was you're in accommodation that they're paying you for, and you scale off. Let's say that you're in, I don't know, New Zealand. They sent you off to New Zealand because you needed a special project, and you're the person that they sent. Now, you go over there, you live there, but then you come back. And that period of going over there would be exempt, because it's the fact that it's job-related accommodation. And interestingly enough, I've got this here, so hopefully you can see it. So this, if you move because of work, you get 36 months. So 36, that's 3 years where you would be exempt. Now, typically, if you can prove that it's job-related, and that's what you can prove, then it'd be extended even further. You also get allowance. So you could have left the home, Emily, if you decided to move into a new home, but it was being built. Now, typically, you've got 12 months whereby you can move into this new build house, but you're waiting for it, so you're kind of doing that. You do get an allowance, but it can be extended to 24 months as well. So you get an allowance of PR on both properties for that regard, which is quite good. And I talked about job related, which could be indefinite as well. There are different other rules. So you get another 2 years if you kind of leave the property, then come back in. You do get 24 months exempt and 36 months irrespective. So how many months do you get? Quite confusing. What I would say is always kind of understand the scenario of why you've left that property, to come back to the property and ask the question, do I still get private residence relief? The answer will be yes. It would just be kind of which box do we tick to maximize your CGT allowances. So that's something for you to bear in mind for sure. I'm just going to go in to see if there's another question came up. No, there wasn't. Okay, that's fine. So the other thing was taking money out of a limited company. So this is another question that came out. And And I'm going to go through all the ways that you can get money out of a limited company. But something came out, which was interesting a couple of weeks ago. It's come back again this week, or last week, I should say. And then added on top of that, there's another call with a client who then asked a similar question, but in a different fashion. I wanted to try and bring it all back together to find out how we can answer that best way in terms of extracting money out of the company. The first thing is, people say, is can I charge, if I loan money, let's say £100,000 to my limited company, can I charge it interest as an individual? Well, yes and no. If you charge your company interest, then that becomes a tax benefit to you and a cost to the company. So it's bringing down the corporation tax problem, but it's going to have an income tax liability for you. And if you do things properly, then the company should do a CT61 form, which is a quarterly form to say that it's paid an individual interest, and therefore it has to also deduct 20% income tax from the payments it's made to you. So to be honest, it doesn't really make much financial sense if you're an individual loaning money to a company and charging it interest. What does make far more financial running scheme is to have company A that loans money to company B and it charges 358% interest. That would become a cost to company B, income to company A. There doesn't need to be a CT61, but this company is now able to extract money from company B. So that could be a scenario that you could be looking at. The loan itself is a loan, so it's a debt. That loan that you make to your limited company will be able to be repaid to you free from any form of tax at all. So there's no tax to pay on that. We do talk about wages. So you could pay yourself a wage out of a limited company, which is 8628, which is below the national insurance band for employee and employer. So it's a good way of paying those wages out to you. You're allowed as well a further £2,000 worth of dividends. But ultimately, what I'm describing to you is that you can extract, I'm sure you can see the highlighted section here, is that you can extract £14,500 out of a limited company to yourself, provided you've got no other form of income, by the way, and you'll have no tax at all. So that's a good way of using a limited company. If you've got a husband and wife or civil partners, well, you've got two lots of 14,500, haven't you? So you're near enough now £29,000 out of a limited company, and neither of you paying tax. That could be a real good incentive for you to have a limited company structure. The thing that came out, interesting enough, was where someone wants to pay their child. This child is a dependent. Now, wrongfully, they got advice from a solicitor and said, yes, you can pay your minor child money from your activities. But unfortunately, they got that wrong, the solicitor, because you can pay them, sure. But if you've got an entity that's paying your son a wage, which is deducting your form of tax somewhere, then HMRC are rightfully going to say, well, that person's a minor, and you should be paying them out of post-tax profits. So we're going to say that the income you give to your son, which is claiming the income tax relief, or corporation tax relief for that matter, you now will be picking up that extra earnings on your tax return and paying the extra income tax. So you can imagine how much more tax you could be paying as a result of listening to a solicitor that doesn't understand the implications of paying minors from a tax perspective. So that's a warning for you. So don't pay family members that are minors, and minors typically are people that are 18 or younger, or 21 and still in full-time education. Your company can pay towards your pension as well. So the pension contributions, let's say it contributes the maximum amount of pension towards you of £40,000. That £40,000 would be a cost to the limited company and therefore reduce corporation tax. You as an individual now get this £40,000 worth of pension contributions, and happy days. You've got something that's growing your nest egg, and it's also now extracting money out of that company. You could get key person insurance if something happens to you and your business could no longer continue. There are insurances that you can pay for to be able to say, okay, this person's passed away, we need the business to continue, therefore we may need to pay for someone to come on board, and here's a cash lump sum to pay out. You could have periodic tests as well. So if you've got glasses, like I do, but not tonight, then you can pay for, have glasses paid by the company as well as the eye test itself. So that's for VDU work, by the way. I'll just highlight that so you can see that. So that's the VDU work. The company can also pay £150 per annum per person for staff celebrations as well. So if you had a good successful year in the company and you choose to take that person out for dinner, theatre, you name it, you can do so up to £150 per person per annum without it becoming a benefit in kind charge. 1 penny over £150 though, oh, painful. The whole amount would become a benefit in kind and therefore not very pleasant on you, the individual. So make sure you don't go over that £150, scrutinise what you're doing and make sure you keep clear records. You can also give your, I'm not going to talk about perk box tonight, but I will go into gift vouchers. Gift vouchers, I need to take some water. Oh, my throat's just sealed up for a second. Okay, back in the game. So gift vouchers, your company can give gift vouchers at £50 a time to your staff members. So that could be employees or directors. Now, directors can only take £300 in a given year, but that vouchers, whether it's John Lewis, Boots, Waitrose, you name it, whatever shop that there's gift vouchers for, your company can pay £50 vouchers at any given time, but can only go up to £300 as directors. If you're an employee, it could be as much as you want, but you do have to be reasonable with this. I would definitely say that you shouldn't be a shareholder of the company as well as running the business and then trying to claim more than £300. I could keep it to £300 as far as you. But if you do that, then your company can do that and there will be no benefit income company tax charge at all for you as the individual. But it will be a cost to the company and therefore it will get the corporation tax relief for staff benefits. So over to you. What have you used your limited company for? Have you been taking the most tax efficient wages? Have you taken the most tax efficient dividends? And have you been taking vouchers out of the company for your own personal goods without you having a tax bill? If you have, please describe what you've been doing and what have you been spending your money on. It's always interesting because Louise and I will always go to John Lewis, and it's always nice when we go to that shop that we will get the £50 voucher each, because there's husband and wife here. They got £100 vouchers, and we'll also get Perk Box, which gives us a further 5% discount. Ka-ching! So that's where Perk Box comes into it. So some great ways of extracting money out of a limited company without you paying any tax liability whatsoever. Talk about limited companies. This is something, and I'm just wary of time because I've droned on far too much. I've just noticed. Okay, I'll come back to you in a second, you man. But let's just go through another question I had, which was, should you use a limited company? And here's a section that I just want to bring to your attention. I'm just going to get that into one page so you can see this for yourselves. This is all on one page, hopefully you can see it. So this is limited companies, when to use it. So I would say that if you're a high rate taxpayer for the next 5 years or more, people come to it and say, well, shouldn't I use a limited company? I think, I'm not going to mention their name, but someone's on here that I know listening may well be into this current situation where they're a high rate taxpayer, but they're not sure what they're going to be doing in the next 5 years. And as a result of that, they might think about using a limited company structure. Well, that's all fair and well. But if you're thinking about using a limited company structure for 2 3 years and then leaving your job, which means that you become a no rate taxpayer, then it may have made more sense to wait a couple of years, buy the property in your own name, do all the refurbishment to keep all the kind of profits low, and then give up your job, and you are in a much better tax position than you would be using a limited company. So it's all about phasing using the limited company. We use a limited company because we're not going to give up our job. We love what we do, our job being this business. But we're not going to give that up for a long time. So for us, it makes sense to use a limited company, but for you, it may not be. So make sure you plan this up. If you are going to give up your job, or your spouse is going to give up your job, then maybe keeping the properties in your names, using a percentage split that's most tax efficient for you in your individual names. That's the thing to think about. You've got to think about the additional interest cost. So having a loan in a company can be more expensive than a loan in your own name. So do bear that in mind as well. You still need to take money out of the company. So if you're thinking, well, I need all the money for my lifestyle needs out of the company, I'm not going to reinvest it, then you're in a much worse tax position. I had a client where I've had that conversation whereby the profit's going to be £200,000, and they openly said, well, my lifestyle is a lot more than that. I need every single penny. And to be fair, when we've had that conversation, it was quite clear that we was not going to be using a limited company structure. So you do have to be very, very careful before you start opening limited companies up. I've got structure here as well. The structure I want to talk to you about is whereby you've got a company one, which deals with buy to hold investments. So these are properties that you buy and hold and you stick with them. Company two could be whereby you're doing flips. Now, the reason why company two is separate from company one is because banks do not like you to have buy-to-let hold properties mixed up with flips because of the risk profile with those flips. So you don't want to be damaging anything here. Second of all, if there is something going wrong with this flip, you don't want it to affect your other properties. So make sure you separate them out. Now, the interesting thing that came out of the conversation last week was, well, if I want to transfer properties from this is a flip company, and I ended up keeping it, can I not just transfer it to another limited company? And the answer would be no, ordinarily, because you've got capital gains tax, you've got SDLT. But if you had a holding company, so you've got a company over here with buy-to-let investments, another company over here, which is an SPV for flips, but they both are owned by holding companies, you could indeed have this flip, which you now decide to keep. You could transfer that property that's inside that company and move it to your portfolio properties, and it will be there. Wouldn't it be great if I just had nice imagery just popping up just like that? I probably wouldn't be talking to you if I could do that. To be fair, I'd probably be in the film industry, but you know, just a thought, it'd be nice to have these kind of imagery coming out. I've now got visions of Disney coming out in terms of what I can do here, but I won't be editing my video just in case you're thinking I'm going to spend 6 hours doing this. But you can transfer this property from your flip company to this. So now all the buy-to-let hold properties in here, and you can simply close down this business. So you're not paying for the annual accounting. And this came about because of a particular client had about 6, 7 different limited companies, and they wanted flip projects to be done, but they all turned out to be buy and holds because they couldn't sell them. But then they had all these limited companies, so we had to restructure the companies. We were able to put a holding company in place and then move all these properties into one limited company. So it worked out really well for them. But it may not do for you. So I just thought that was an interesting one. You could read the other sections yourself about that. But that's pretty much it in terms of the questions that came up from our clients. Hopefully you found some of that useful. I mean, why don't you tell me what the highlights are in terms of what have you learned that's new? And again, if you've got any questions, please start firing those in right now, because I'll be able to answer those questions within a few moments. I'm just going to take a swig of water as I do that. And what I'm going to do is just take off now my share. So I'm just going to do that now. In fact, what I might do, I've messed up here. So I will do a new share, and we're going to go back to Google. Here we are. So you're going to see this page, and I'm going to get rid of that. Don't forget to join me next Monday, by the way, before we finish. That next Monday, again, will be another YouTube Live, so make sure you hook yourself up to that, and you get your tickets ready for that session. And what I'm going to do now is take my share off altogether, and I'm just going to talk to you now. So stop share. I'm on full screen. Hello and good evening again. If I've gone full screen, you've gone, oh, that, you know, I understand. I sympathise with you. Yeah, it's not the most pleasant place to look at, is it? Let's just have a look tonight and see if I can do anything with those questions. So you Mangs asked a question. I've just got a man one, Shabnam Patel. Oh, crikey. I'll tell you what, I need my glasses. I'm going to zoom this up. But you Mangs asked, so yes, back to you, by the way, man one. And you Mangs asked a question. So can a property management company give me a job-related accommodation and then I let it out to property and not lose anything in CGT? Unfortunately, you Mangs, that's a lot more complex, and the answer will be no. Because your company won't be giving you a job-related accommodation. It's close connected companies, and therefore HMRC will see straight through that, unfortunately, and say, no, not that. You're not an employee of another organisation that's separate from you. So that tax thing will be cut out from you, unfortunately. I know that someone tried to do that, but it wasn't given, unfortunately. So that's pretty much me done. So don't forget, if you've been watching this, it's been useful, give me the thumbs up, and also make sure that you're here for next Monday. In fact, tell me what you think about the format. If you've been with me the last few weeks, you normally get this boring wall, and that's all you get to see. I've actually painted it white, even though it still looks great. But I've painted it white, so it looks a bit better. But I wanted to introduce a bit more visual. So was Google Chrome sharing the newspaper articles useful for you? If it was, please let me know. That was useful. And indeed, I've typed up the client's FAQ, so you can visualize those as well, rather than just listen to me. And that's hopefully giving you some useful tips. So did you like that? If so, just type in yes. That would be really fantastic. Appreciation. So yes, I like the visuals. Okay, or no, I thought it was rubbish, and try much harder. I'm totally up for candid feedback, but let me know how I can improve this session even better for next week, because I took that feedback from someone else listening in terms of giving the visual representation. I will do the same again, so I'll make it really, really good in the future. So feel free to type your questions, also to give me a thumbs up, or indeed how we can improve as well. In the meantime, thank you ever so much for listening in, guys. Have a fantastic week, and whatever you do, be successful, be happy, work bloody hard. All right, guys, thank you ever so much, and see you again soon. Bye-bye.